Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Private Lending Roadmap, The Guide to Retirement with Kevin Amolsch. I'd also like to thank you for joining us today, Kevin. As a quick note, please be aware that we will be taking questions throughout the presentation, so feel free to use the Q&A function through Zoom, and we'll address them when we can, and we'll also be addressing questions at the end of the webinar in a dedicated Q&A portion. So please use the Q&A function, not the chat. So we have it in one area. And then before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it does come to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Kevin.
All right. Sounds good, Will. First of all, I want to say thank you so much to you and everybody that's on the call or the webinar today. I promise I'm going to do the best I can to give you a ton of information, help you make a little bit of money with this unique and very profitable tool. So thank you, Will. So we're going to be talking today about private lending. And before I start, Will, can you see the screen?
Sorry, I was muted, but yes,
right.
your screen is coming through good.
All right, I'm trying to get this to show the, so we were blaming Zoom for the technical issues that we had, and I can't even get this thing to pull up as a full.
If you click on the slideshow tab at the beginning or at the top, do you see the tab that says slideshow?
Well, no, because all the Zoom stuff's right in my way. Let me see if I can move that out of the way. Oh, here we go. Right here?
Yep.
Yeah, nothing's working. Oh, that's crazy. No, I'm not going to worry about it. We can just still see that. I'm just going to keep going. I know we're running a little bit short on time because we've already had some technical difficulties. So let's just go through. It doesn't really matter here. What matters is the information and that everyone gets that. But it won't even let me click through now. Jeez. Do you go ahead.
If you want, you can send it to an email address. I'll put in the host and panelist chat, and I can cycle through the slides for you.
Yeah. See if I can make it out to email. Okay, let me do that because for some reason it's not pulling up.
No worries.
Gosh, sorry guys.
Technology, it never works when you want it to.
Okay, so you're going to put that in the chat, you said.
Yeah, you should be able to see it now.
There it is.
And I'm watching the email inbox right now so I can pick it up. Again, sorry for the technical difficulties, everybody. This was on the beginning was on Zoom, and PowerPoint seems to be acting up now.
It's not making this easy either. This is one of those you probably restart the computer and everything works perfect.
Yep.
And we're in the middle of a live session here, so that's not going to happen.
Tech support 101, unplug it and plug it back in again.
That's right. Okay, so that's off. We should have that.
Okay.
While you're pulling that up, well, I'm just going to share my little disclaimer here. I'm not going to read it like you did. I think you did a fantastic job there, but I do want to reiterate that this is for educational purposes only. I'm not giving investment advice either. We do this for a living. We do this business, but we're not offering it in this setting. We're really just trying to provide some education. Now, I got started investing in real estate super young. I was 21 years old when I bought my first house, and quickly learned that real estate is a fantastic way to build wealth. So I started focusing on that. And I started buying 1 or 2 houses every single month while I was in school, working a mostly full-time, 30 hours a week job. And what I learned through this process is the passion I had for real estate really comes down to finding and negotiating the deals. And when you learn real estate investing and the art of negotiating the deal with, when you're sitting across from a motivated seller, you learn that the offer and the approach and the negotiation all comes down to one thing, and that's the financing side. So I really fell in love with the financing side and became a mortgage broker. That gave me a big headache after all the pounding my head into the wall. Really had no control as a mortgage broker. And I ended up learning how to raise private capital and loan that out to real estate investors to do fix and flips and some rental property rehab projects. So this was back in 2006. Did that for 2 years with a partner, ended up separating from her. She wanted to teach real estate. I like to do real estate. This was right when the economy was collapsing around us. And I started Pine Financial Group in 2008. Since then, we've done about 2,300 loans, coming close to $1 billion in originations. So I'll give you a quick background there. All right, Will, are we up on the slideshow?
I'm throwing it up right now.
Nice.
Just give me 1 second.
So the photo here on the slide that Will's going to pull up for us is me and my family. I have a blended family. So between the two of us, we have 5 kids. And this is a photo of us in Cabo, maybe 4 months ago, 5 months ago, maybe.
Zoom is not being our friends right now. It will not let me share this PowerPoint for some reason.
I got to tell you, ever since COVID, and we've all experienced this, but ever since COVID, you get really comfortable with a platform like Zoom, and you're using it. Gosh, it seems like every day we're on this thing, and then sometimes this happens, right?
Absolutely. Doesn't help that it is also on a Mac, and I'm definitely a PC guy. I think. Can you see it now?
Yes.
Perfect. All right. Let me bring that up full screen. All right. Is this the slide you like to be on?
That's the one. Yeah. So that's our little family on the beach in Cabo. So yeah, if we just go ahead and move on to the next slide, the topic. So these are the 3 things we're going to talk about today. What is private lending? Why do savvy investors love it? The nuts and bolts and the differences between investing in individual notes or whole loans. We call it trust deed investing, whole loans, individual loans. It's all the same thing. Or investing in professionally managed mortgage fund. So those are the 3 topics.
Sorry, just tell me when you want me to continue.
Yeah, go ahead and move it forward. We can go again. What is private lending? So it's really simple. It's just a loan from an individual, maybe somebody like you that's got money in a self-directed IRA account, loaning it to somebody else. Now, these could be really anything. You could loan money secured, unsecured. What we're talking about today is absolutely secured loans, and we're securing it with real estate. Look, real estate is easy to repossess. It's not going to drive off like a car might. So we really like real estate as collateral. Terms can vary greatly. I said it's not uncommon to see rates of 10 to 12%. You can also partner, so make a loan to somebody who's doing the fix and flip, let's say, and maybe you have a lower return, 6-7%, something like that, but you get a little piece of the upside, so you can participate in profits. We could talk more about the different creative ways to structure these, but this is why investors love this business. All right, next slide. Okay, here's just the reasons. High returns, it's passive. I talk to real estate investors on a daily basis, and what I find funny sometimes is when they tell me they're building their rental portfolio and it's totally a passive investment. Now, I love real estate and I love rental properties. I think people should own real estate as rental properties, but I would argue that it's not necessarily passive. You do have to manage the property. You do need to manage the tenants. And quite honestly, you need to manage the managers. I've got plenty of stories of managers not doing a good job on some of my out-of-state properties, and I'm constantly trying to stay on top of them. This truly is a passive investment. You don't even get a check in the mail. It's all direct deposit. You have access to deals that you wouldn't ordinarily have, and there's cash flow. A lot of times with rental properties, especially in a market like we're in right now with rates high, values still high, it's hard to find investments that are going to cash flow. Okay, next one. And it's secure. I would argue that private lending against real estate is far more secure than even owning the real estate. And the reason for that is if there's a liquidity event, the very first investor to get paid is any creditor. So if you're in a lien position on that property, especially a senior lien position, you get paid first whenever that property is liquidated. So I really believe that it's a much more secure investment, and it's stable. It's just something that you can count on. There could be defaults and things like that that you have to deal with, just like a tenant stopping pay, to not making their rent payments. So there is always that risk, but it's much more stable than, gosh, almost any other investment that I've seen, as long as you're not getting into treasuries or bonds or something like that, which those don't pay a high enough return. All right, the nuts and bolts of private lending. So here's how the process works. Find a deal, qualify the deal, make the investment, and then service your investment. So a lot of people just make the investment and just hope everything happens as it's planned, but you got to stay on top of the servicing on this, and we'll talk more about that. So the next slide is going to tell you finding the deal. So here's some strategies and some ways you could find these investments. Your borrower finds the investment, you find the borrower. So that's key. You don't have to be out there looking for real estate deals, motivated sellers, foreclosures, any of that. You got to find the borrower, which is far easier to find, and let them go do all the hard work in finding the projects. So how do you find the borrower? Well, networking is by far, hands down, the #1 way to do this. I put on here realtors, friends and family, real estate investment groups or clubs. You hear these are your RIAs, title companies. Oftentimes deals fall apart at closing. We just had one yesterday fall apart at closing, so I know that happens. It's awful nice to have the title company pick up the phone and call you to fund the transaction because the other lender couldn't get it done. And then wholesalers. I'm assuming most of the people on this call have an interest in real estate, so they understand this, but quickly, a wholesaler is someone who's out there actively looking for deals. So they're sending out direct mail, they're making cold calls, they might be knocking on doors, they're hunting for projects, but they don't necessarily want to do the projects. So they wholesale those to other investors who could do the rehab and retail them. So they might mark them up 5, 10, 15 grand, something like that, leaving enough meat on the bone for a fix and flipper to make a profit. And then they just turn the deal over to the fix and flipper. I love wholesalers to find properties because they want their fix and flipper to close. Like, they need the money to close so they can get paid. So that type of referral is common, and it's a fantastic way to go. Seminars. I've built Pine Financial on this model, giving away free information, and Camaplan's doing something similar. When you could add value to people's lives, they want to work with you. So I absolutely would encourage you, if you're out there looking for borrowers to fund their projects, to put on some new investor or fix and flip seminars and just let them know that, hey, look, I could fund your projects for you. You can advertise. I don't love this. I could tell you about 10% of our new business comes from advertising. It really is word of mouth, repeat business, and networking is where you're going to get your most business. But some ideas for advertising: pay-per-click ads. You could advertise on different websites like the Bigger Pockets and the REI Club. The ones that have hard money lender or private money lender lists, they'll list you on their list for a fee. So all of that stuff could potentially work, but again, it's probably not worth your money if you're just doing, onesie twosie kind of investments. You really want to focus on the other options here. And then mortgage brokers and private loan brokers, absolutely. Look, mortgage brokers, if they're brokering to the big banks, Wells Fargo, for example. I know I always pick on Wells Fargo, but your mortgage brokers that are going to Fannie Mae, Freddie Mac, or some of these larger banks, they can't finance the type of properties that real estate investors are fixing and flipping. And it's because of the word habitability. If a property is not habitable, it's not financeable in the conventional world. And that's exactly what the fix and flipper is looking for. They want a project that they could add value to it, because that's how they make their money. By adding value, it needs to be a property in poor condition. So oftentimes these conventional lenders can't finance these. So they'll refer the business to you. What I find interesting is many times the clients that come in, and that you'll see this if you're out there making private money notes, they want to hold the property as rentals, but they can't finance them because of the habitability requirement. So they'll come to someone like me or you to finance the project, get it rehabbed, get it nice, get a tenant in there, and then they'll go and refinance it. So it's absolutely perfect referral for a mortgage broker, because they could send the business to you, you get it done, get the property financeable, and then they'll do the refinance. So you both get a loan out of the transaction, and you won't be sending that loan to another mortgage broker or banker, because you want to continue to work with this one if they're going to be sending you referrals. So it's absolutely a win-win. I love that. There's also mortgage private loan brokers. So these are the guys that just broker private money or hard money. And so they'll bring you deals. They want to get paid on it, so you might have to pay them a little bit on that. For us, we require that they get a fee agreement signed with their borrower, and then we disclose all of that on the HUD. So it's very, very transparent. And we maintain our fees that we want to charge. So it's just an extra fee that they tack on top for the borrower for helping them locate and line up the money. Both mortgage brokers and private loan brokers, you could find these guys again at the real estate investment clubs. So I think we're good for the next slide. So qualifying the deal. Yeah, and well, if you just want to put the whole slide up, that's probably fine. So qualifying the deal, you need to get their financials. So this is qualifying the borrower themselves. So when we go through this process, we really want to look at all the borrower as their quality, how confident we are they're going to make the payments and pay us back, but we also want to look at the deal. So we're looking at both. So this is more of a global underwriting standard, I guess. Back in the day, hard money and private money notes, like we're talking about today, were really asset-only loans. And we hear the joke sometimes, if you hold the mirror in front of your face and that thing fogs up, you're approved for the loan. Like if you're literally breathing, you're approved for the loan. And it used to be that way, but now it's much more of an industry, and there's more standards, and you really do want to try to qualify the borrower. Look, we're in the business of making loans here, not trying to repossess properties. Unless that's your intent, then maybe you don't care about the borrower's quality. But for us, we want to look at the financials. So this is going to be a PFS, or a personal financial statement, or an application. So we want to get the assets. We want to get their liabilities. That'll give us a net worth. We want to get their income and their expenses. And so we know what their ability to make the payments on this loan. So those are the four things: assets, liabilities, income, and expenses. Now you'll get the liabilities and expenses from their credit report. So you might not necessarily need to ask for that question, but you definitely need to know assets and income. For us, we're not so worried about a total net worth. We have clients that have $10, $20 million net worth, but it's all stuck in real estate, which is illiquid, not liquid. What we're looking for is liquidity. That's how you're going to stay safe, and that's how your client's going to stay safe. So for us, we have a requirement of 10% of the loan amount in a liquid account after closing. So any money that they need to bring to closing, they'll need that plus another 10% in reserves in case something goes wrong, because look, things go wrong. Credit report. We pull a tri-merge, which just means that we pull all three of the credit bureaus, and we look at the middle score. Now we're tightening up on these guidelines now because of the looming recession. So we're looking at a middle score, the middle of the three, of a 650 or higher, unless there's some pretty significant compensating factors like a lower loan to value or extended reserves or something like that. So we are paying more attention to the credit reports than we have in years past. I don't necessarily worry about past history as much as where are they at right now? Is there a ton of debt? Is there a looming bankruptcy? Are they currently falling behind on credit cards or car loans or something like that? All of those would be an indication that the quality of the borrower is not quite high enough for at least our standards. Supporting documents. So they're going to tell you their assets. They're going to tell you their income. Let's just make sure. Let's get some bank statements. Let's maybe get a tax return. Let's just make sure that what they're telling you is the truth. Actually, just verifying their story tells you a lot about somebody. But that aside, I really want to make sure that they have at least those reserves in the account, because that's how they stay safe. So absolutely, without question, do not make a loan to somebody without checking their bank accounts to make sure they have some money to handle a problem. Title commitment. So this is working directly with the title company and making sure that your lien is going to be insured. So when you make a loan to somebody, you're going to record a deed of trust or a mortgage, one of the two, depending on what state you're in. And you want to make sure that that lien is fully insured. So they're going to commit to the insurance, the title company will, under certain conditions. So you want to read that and make sure all the conditions are met. And any exceptions to the title policy you can live with. So they might say, well, we're going to insure the title and your lien, but we're not going to insure encroachments. Maybe they think a neighbor's fence is built on the property or over the property line, something like that. So you would see all of that in the exceptions section of the title commitment. So get a title commitment, read it, make sure you understand it. If you don't, please have an attorney help you understand or interpret the title commitment so you know exactly what type of insurance you're getting on your loan. Appraisal, we want a good valuation of the real estate. Look, we do want to qualify the borrower, and that's going to be our first line of defense to stay safe. But defaults do happen. Sometimes we have to repossess a property. If we're going to repossess a property, we want to be dang sure that there's enough value in that property that we get our money back. So we're really trying to eliminate or severely reduce risk here. So let's get a full appraisal. Let's get somebody's professional opinion of what that value is now and when it's all completed, all the construction is done. And that way we can stay safe in our loans. For us, we want to stay at 70% of the value or less. And we're actually considering tightening that just a little bit too, just to be extra careful as we go into whatever's coming. Repair estimates, the only way to get a good value on after repair is to know what they're going to do to repair the property. So we get a whole scope of work or a repair estimate, and our repair estimate includes a executive summary. So they have to write out, what is it going to do? What kind of countertops are they going to put in? What is the appliance package or whatever details they can give us about their construction project. Sometimes if they're going to be moving walls around or adding some square footage, we might want to see, almost always we'll want to see the floor plan or the drawing. So that's how we were going to come up with the completed value. And then finally, insurance. So we talked about the title insurance and going through the title commitment, but you also want to have hazard insurance. So what if the roof gets damaged by a hailstorm or a tornado or a hurricane? Or what if there's a fire? I've had fires at several properties. How do we know that we're staying safe here? And that's going to be in the insurance policy. And one thing, Will, about the insurance policy and everybody else, I see this mistake happen a lot. In fact, I think I talk about it later, but I'm thinking about it now, so I'm just going to mention it. When you call your insurance agent, they're going to ask you one question. It's going to be, are you planning to live in the property? And your answer is either yes or no, right? So for our fix and flip claims, their answer to that question is no, I'm not going to be living there. And the insurance agent issues a landlord policy. This is very, very common because there's not a lot of fixing and flipping, and insurance agents don't necessarily understand that business. So they're going to issue a landlord policy. And the problem with the landlord policy is that it has a vacancy clause. Vacancy clause just means if it's vacant for 30 days or 60, depending on the policy, you don't have insurance at all. So I have seen some private lenders get into trouble by having landlord policies on fix and flips, which means they don't have insurance at all. So just be very careful when you're working with your insurance agent or your client's insurance agent, that they understand that it is vacant and there is going to be construction, because that's a little bit riskier than a rental property of the family living in it. All right, I know I'm talking fast, guys, but we got a little bit late start here and I got a ton of info. So I'm going to keep going. If there's any questions, go ahead and put those in, and we'll try to take on some of those as we go through. Okay, so you have your client. You found them at your RIA. You found them at your networking event. They have a fantastic deal. You qualified them. You qualified the deal. Now you want to make the investment and start earning this passive return. So how do you do it? You work with the escrow company or the title company. Some states it's the attorney directly. You want to make sure that you put together that settlement sheet. The settlement sheet is the most hands down important document at the closing for you to review, because it's all of the numbers on the transaction. Who's getting paid? Where's all the money going for? How does it all settle? Is the borrower putting enough down payment or enough skin into the deal? All of that is on the settlement sheet. But before you can review that settlement sheet, you have to send your figures into the title company to help them put that sheet together. So making sure you get paid. Are you charging origination points? Are you charging for an appraisal? Are you charging for processing the loan or underwriting the loan? Whatever fees you want to charge, make sure the title company gets that on the settlement sheet. If there's a private loan broker or a mortgage broker trying to get paid, you want to be sure that's on the settlement sheet as well. Once you have that approved, you're ready to close, you'll need to wire in your money to the title company and then create and execute the loan docs. Now you could write this down. I put where you could find some free loan documents. It's going to be no matter what state you're in, you could use these. When I was getting started in this business, this is exactly what I did. I quickly graduated into some attorney prepared documents, but this will at least get you started if you want. But I will say I highly, highly encourage you to get some lender favored documents from your attorney. You want everything weighted in your favor. They're borrowing money from you, a lot of money from you. So let's just be careful with that.
Before we move on to the next slide, I do want to address a question that it looks like it was asked towards the beginning of the presentation, but I missed it when we were fixing the technical issues. This is directed to self-directed IRAs. Bill asks, can I use my wife's Camaplan SD IRA to fund the startup of a hard money lending company that is operated and managed by me? Answer to that is no. Your wife would be a disqualified person to you and vice versa. So you would have to have a non-disqualified person if you wanted to use IRA funds in that investment.
Yeah, and correct me if I'm wrong here, Will, because I do agree with you, absolutely. My only question to you would be if it's funding the loan itself and not the business, that would qualify, wouldn't it?
Yeah, you can assist your wife in making a loan where the IRA is lending it to a non-disqualified person, as long as it's not directly to an entity that you manage yourself. Right. That is possible, correct?
Yeah. Okay, just thanks for clarifying that.
Of course.
Okay, so once you have the loan, you have it, you've made the investment. Now we got to service the investment. So it's really simple, right, guys? You got to make sure that you're collecting payments. Oftentimes I see, I think this is layer 2, but oftentimes I see private lenders not accept payments or not require monthly payments. Here's the problem. Your borrower is going to ask you to defer payments till the end because it helps with their cash flow. It makes total sense. The problem with it is they're not going to call you when there's a problem with the project. I've never once got a call say, hey, I screwed up, right? That doesn't typically happen. The only reason I would get that phone call is, hey, I screwed up and I'm not going to make my payment this month. So it's that payment that is going to spark the phone call, or not. If they don't call you, but they don't make a payment, at least then you know there's a problem and you can call them. Look, we have to stay on top of these investments, especially going into a recession. Speed is key. If you don't have that monthly payments, you're not really communicating with your borrower, and you may not even know if there's a problem at all to fix. So strongly encourage you to require monthly payments. I sell it to the borrower like this. Look, I know this is uncomfortable for you to make the payments, but that's exactly why you're going to make more money on this project. That monthly payment pressure will speed you up. It's going to make you work faster, and you work faster, you make more money. So you're welcome. Okay, monitoring the construction of the project. Whether you're funding the construction or not, I do encourage you to visit the property just to make sure that the construction is happening. We have different benchmarks and how do you call it when like trip line or I can't think of the term here, Will, but if we don't get a request for a draw within X amount of days, then we know that we need to go out and take a look and just making sure they're moving along, making progress. So that type of process in your servicing is pretty important. But definitely at the very least, if you're doing construction draws, you're issuing draws to your borrower for work that they're doing on their fix and flip. Before you give them the money, go out and look at the project, make sure that the work that they said is done. Not that a borrower would ever lie to you, but it's possible that a borrower will lie to you. So let's just go out and get eyes on the project. Handling defaults or slow pays, we talked a little bit about this. We got to stay on top of these. I know I've fallen for this so many times when I was a young new landlord, where the check's in the mail, or I had this issue over here that's preventing me from getting you paid, or something over here is in the way. Can you just wait a little bit? And we start waiting, and then the next month something else came up, and the next month it's something else, and you just fall farther and farther and farther behind, and then you get in trouble. Then your investment's at risk. So I would say very strict. Late fee on X day, we do the 5th, late fee on this day, demand notices go on the 15th, and then we start the foreclosure if that demand notice expires. Now, we will have some lenience if there's a good reason, but never would we have any lenience on issuing that demand notice. At least that gives us the flexibility that if they did lie to us or they're not coming through on their plan, then we can get it over to the attorney right away. Because there is like a 30-day wait after you demand the money before you can start the foreclosure process in most states. So just handling the defaults and slow pays has got to be very systematized and quick. Payoff statements and releases, this is when they're actually going to pay you your money back. The title company will typically reach out, or your client will reach out to you and say, hey, I'm ready to pay off the loan. What do I owe you? And it's going to be a very formal letter that has to go to the title company. That's going to list the total principal, any fees that they owe you, if you're charging any fees on the back end, if they miss payments or late fees or any of that, all gets itemized and then sent off to the title company. And again, that's for them to create that settlement sheet to make sure that you get paid. And then I will say this on the releases, and you will get pushback on this, but I would encourage you to be very, very firm here. Unless it's a large title company, do not release your lien until you get paid. There have been times when title companies have accepted funds for a payoff and then not given it to the lender, and then the lien is released. Obviously, that's fraud, that's a crime, all of those things. And yes, I have seen that happen more than one time in my career. So I would never release a lien until I have my money back in my account. Look, it's much easier for them to get you to release a lien than it is for you to go get your money if there is no lien at all. So I would just encourage you to stay firm here, get paid, and then release. And then tax forms. It is a good idea to send your borrower tax forms. So for the borrower, it's a 1098 that just says, this is the amount of points, this is the amount of interest. So they can report that on their tax returns. Most borrowers expect that. If you're just doing 1 or 2 deals, probably not that big of a deal, but it's actually not that hard to create those either. Your CPA could help you with that. So that's all part of the servicing your investment. Oh, I did throw a little extra in there, and I think Will did a good job at the beginning of mentioning this, but your self-directed administrator is not a loan servicer. That's not their job. So you can hire professional servicing. There's companies out there that will do it for you. Or if it's pretty simple loan like this, just accept the payment and send it off to CamaPlan, or have them send the payment directly to CamaPlan. But just know that they're not going to be pursuing the borrower if there's a default or something like that.
Thanks for clarifying that.
Sure. Okay, so where do you find the money to invest? Well, a lot of people just have the cash sitting in an account, right? Or they're pulling money out of the stock market because they have zero confidence there, something like that. So obviously, if you have the money, that's a pretty simple one. IRAs and 401ks can get a little bit more tricky. Now, if you're on this call, you understand the self-direction component here. You could also potentially borrow from a 401k and use that, and then you create a little spread there that you benefit from, or your IRA benefits from. But we have a lot of clients that use self-directed accounts, so that's very common as well. You could do other people. Like the gentleman that asked you the question earlier, Will, about starting a hard money lending company. Most hard money lending companies start and get going by raising capital. Some go the institutional investor route 100%. Those typically go out of business when there's a rising rate environment like we're in now, or a 2008 like we've seen, because their lines get shut off or there's big margin calls. So a lot of the hard money lending companies that are sustainable maybe have all private investors or at least a portion. So absolutely, you can get money from other people. I should say this, so if you're doing that way, especially for the gentleman that asked the question about starting a company, just be very careful. I would get with a securities attorney, very different than the real estate side. You may need to be licensed on the securities side to bring in private capital. And then obviously when you loan money out, onesie twosies, no big deal, but you could potentially need to have a license to loan the money out as well. But just be careful, especially on the security side, if you're bringing in private money. And then you could borrow money. So I went through a little example here, and this is becoming very much more less, does that make sense? Attractive because of the rising rate environment. But I wanted to go through an example of what it would look like to have a spread. So on the next slide, well, we go through the spread. Now, this is exactly what banks do to make money. So it's not like this brand new concept here, but I'm trying to be as realistic in this example as possible. And I'm just saying you could borrow at about 7%. Mortgage rates are in that range, so that's why I use that. You could lend at 10%. We sell a lot of loans when we need to create liquidity, and that's what we pay our investors. So that's why I use that. Obviously, if you're loaning to an individual yourself, you'll probably get higher than 10%. So this would look even better. So in this example, let's say it's a $200,000 loan. All I do is take the income, 200,000 times 10% return divided by 12. Your monthly payment is going to be almost $1,700, $1,666 a month. Your expense, which is going to be your payment on the loan that you're borrowing at 7%, would be almost $1,200, so $1,166. So I just take the difference there, and that's $500 per month passive cash flow without any of your own money. So that's a no money down passive investment. Obviously, whenever you use leverage, it's a double-edged sword. It could work just perfectly like this, and you make $500 a month that you didn't have before without any of your own money. But if there's a default, you have to keep making those payments on that loan or you're in trouble, right? So it is much higher risk when you bring in leverage to the picture. All right, the differences between whole loans or investing in single notes and the lending fund. I think I just go through 2 slides here, just advantages and disadvantages. So a single note is what we're talking about today, just making a loan to an individual that's going to do a real estate transaction. Higher returns, you typically get higher returns on the single notes on that one specific investment. You may end up getting the property. Some people do the loan to own strategy and they want the property. So that could be an advantage if that's your goal. It's secured by one property. So your name or your IRA's name is going to be in the public records as being the lender on that. Very transparent. You don't need to worry about Ponzi schemes and somebody else mismanaging your money or any of that. That's why some people really like the single note route. Mortgage pools. This is more of what we do. We've got several mortgage funds. Our most recent is a public fund, which is kind of a fun thing we've been working on. So inside of a pool, how that works is you make your investment into a fund with a lot of other investors, and then the manager loans that money out. So think about a mutual fund. You invest in this mutual fund and the manager's making the investments on your behalf. So very similar. Advantages here is it's diversified. It's very consistent. I should mention that. It's not, here's a loan. Okay, now it's paid off. Now let's go find another one. Okay, now it's paid off, and rates and everything are different. No, it's the same consistent return 365 days a year. It's diversified. So if there's a loan on one property that's, say it's a flood damage or a fire, or the tenant or the borrower defaults, it's not going to really impact you as much because it's spread over a lot of properties. So diversification, one of the keys to safety and investing. It's truly passive and it can be liquid. That's huge. Individual loans are not liquid. There's no market for those loans. typically will need to sell those at a discount to find a buyer for them. You never have to worry about getting a house if you want the passive investment, especially in a retirement account. Much easier to deal with cashing checks than problem properties. That'd be a big advantage. And you never deal with borrowers, foreclosures, mispayments, or any of that. Now, the disadvantages: single notes, excess cash. Let's say you have that $200,000 in your IRA and you want to go make a loan and you find a borrower that wants to borrow $180,000. Fantastic. You have enough money to make that investment. But what happens to that other $20,000? So that's sitting in the bank, typically making almost nothing while you're doing a fantastic job on the $180,000. So that little gap there, that excess cash, brings the return on the entire amount available down. The time between deals. So let's say you have a deal that goes for 5 months. They fix it and they flip it, pay you back. Takes them a month. They find another one. You fund it. Fix and flip takes that. Maybe that one takes 6 months. So now we're 12 months in. One of the 12 months you earned no return. That brings the annual return down, obviously. It's not like liquid. Payments could stop at any time. Disadvantage of the pool: you don't get to look at every individual deal. You're really trusting the manager to manage it appropriately. So pick a good manager, someone with a track record. Slightly lower return than you would get on the individual, but I would argue that over a year, without the excess cash issue and the time between deals issues, you're probably getting a higher return because it's very consistent through the year. And then a disadvantage is, if you want the real estate, you're never going to end up with a property if you're investing in a fund. All right, I know we're running short on time, so I'm trying to cruise through here. I did a real quick example. If you invested in the S&P over the last, what did I use here, 30 years or something, 20 years maybe, you can see the tremendous volatility in the stock market. And I'm just comparing it to I compared it to our fund, which is an 8% flat return. It's just going to be very, very consistent. Maybe that adds some stability to a portfolio. If you invested 100,000 at a consistent return compared to the stock market, that's just a comparison there. So I guess depending on when, either one could be better than the other. But the good thing about a mortgage fund is it's exponential. So you'll see that, especially if you continue this graph out, you'll see that red line start to shoot through the roof. All right, top mistakes. Try to get through this fast here. Top mistakes: investing in junior positions. Oh my gosh, if I had time, I could tell you stories about people losing their entire investment. And this one sweet old lady, she was in a self-directed retirement account, invested $80,000 into a junior position and lost it all. There was nothing I could do to help her. It was already too late. She made the mistake in investing in the wrong position. If you're investing in a junior position, you better be able to take out the first, because if you have to foreclose, you have to pay off all the liens in front of you in order to get the property back. So don't just go invest in a junior position just because it's a smaller loan amount. If you're needing a smaller loan amount, that's the exact reason not to invest in a junior position. Fractionalized loans are, okay, you take 50%, I'll take 50%. Now we're combining on this one loan. Problem is, if there's a default, who manages it? Who gets the house? How does all of that work? A lot of times there's loan brokers out there that will broker a fractionalized note like 10%, 5%, and they just stack the capital. And then it becomes a real problem if there's a default. So be careful with fractionalized notes. Be careful on your, I know I keep saying be careful. It seems like I'm repeating myself, but the property valuation, you really want to get that right. Improper insurance, which we talked about, and then stay on top of your servicing. All right, we have 8 minutes for questions here, but I wanted to give anybody, Will, if they wanted it, a free report on private lending. This is kind of what we talked about today. So how you can go out and do it on your own. So if you're more interested in getting a higher return and investing in other people's projects, you can get that report for free. The other one here, email me, Kevin@pinefinancialgroup.com, and I'll send this one to you. This is just a brochure on our public fund. So this is a fully approved fund with the SEC. Twice or semi-annual reporting, audited financials, all of that you would get with the public security. So this is just an informational brochure on that.
Thank you, Kevin. So if anybody have any questions, or if anybody has any questions, please use the Q&A function now, whether it be for Kevin or myself regarding self-direction. Now would be a great time to utilize the last 8 minutes. While we're waiting for people to start typing in their questions, Kevin, do you have anything I know you went over that one scenario with the self-directed IRA and the older lady who lost her money. Do you have any tips for people who wanted to use any of this knowledge when it applies to their self-directed IRA?
Yeah, I mean, if it's a smaller amount like that 80,000 in that example, I would absolutely go into a fund because you're safer there. Now, when you're going to do diligence on a fund, you're going to have to dig into the manager of the fund. So look for Google reviews or Yelp reviews or any reviews you could find online, any complaints. Maybe you want to check with the BBB. And it's interesting because I haven't had requests for references in probably 7 years. 2 investors that just invested with us both asked for references. So I guess that's coming back. Maybe if you're going to do some diligence on a fund manager, maybe ask for references and actually pick up the phone and call the references and see what their experience has been.
All right. Thanks, Kevin. We have another question from anonymous attendee. What is the minimum investment for your fund?
Yeah, so all the documents say 25,000. It's been like that for 14 years. We've been doing $25,000 minimums. With that said, because of what's going on in the stock market and people just losing money hand over fist, we decided to lower that to 10,000 just to help more people get a little more stability in their portfolio. So the documents will say 25, but we will accept as low as 10.
Thank you. Bill also asks, this one is more directed towards self-directed IRAs. My wife cannot start a business and use the SDIRA to fund that. No, when you're investing with your self-directed IRA or any IRA, it has to be an arm's length transaction. It can't be any business that you operate because you're providing a benefit to that IRA. The only way I've heard of people being able to use retirement funds to run a business is through what's called a rollover business startup. We don't do those. I believe it has to be from a 401k. I'm not very well versed on that. So you should do your research if you have a 401k, but not with an IRA. You can't run a business out of your IRA. Another anonymous attendee asks, are you accepting only accredited investors?
No, that's a beautiful thing about being public. We don't have any accredited versus non-accredited limitations at all. So we're taking everybody. And I want to go back real quick, Will, to the question on the minimum. So I answered that correctly, but I do want to say that we have seen in most cases for IRA investors, it's about 25,000 before it starts making sense because you have the administration fees, and we just got to be aware of those. You don't want to make a $10,000 investment, earn 8%, and then have that totally wiped out with fees. And the administrator has to make money also. So just be careful there, I guess.
Thank you for that. Mike asks, can you explain more about the liquidity? Is there a minimum time to be invested? How quickly could you execute a full exit if needed?
Yeah, so we have no lockup periods, we have no fees, we have no penalties, and none of that. We make our money on a spread and fees that we charge our borrowers. So I want to get that out of the way. And as far as how quickly can you get your money back, everything you read will say 90 days. It's never taking us that long, but we want to build in a little buffer so that we have time. We make loans, right? So we don't keep it in the bank account. We do have money in the bank as a loss reserve, but we can't access that to return capital. So really, we try to keep that account at a zero balance or close to it so that we can generate a return. So for that reason, we do need a little bit of time to liquidate some loans in order to return capital.
All right, perfect. Thank you. Bill wants to thank you and us for the answer. So you're welcome, Bill.
Thanks, Bill.
And that's all the questions for the moment. If you have any additional questions for Kevin, his email address is there, and I'm sure you're welcoming emails to that if they have any questions regarding the presentation. Another thank you from an anonymous attendee. I want to thank you, Kevin, for the wealth of information you provided today. So definitely reach out to Kevin with any questions. And if you have any questions about self-directed IRAs, my contact information was in the beginning of the presentation, but you can always email info@camoplan.com or give us a call at 215-283-2868. I'll end it on one more question. A last second question from Mike. Got in right before the bell. Does the rate of return vary with the market?
Not for us. No, we've been very consistent with our returns, so we are seeing a little squeeze in our margins, but we're paying out the rate of return to our investors the same.
Perfect. All right. On that note, thank you guys again. If you missed any portion of this webinar, it was recorded, and everybody who registered will receive a link to the recording within the next day or two. And again, thank you all, and I hope everybody has a great rest of their day.
Thanks, Will. Thanks, everyone.